President Kaplan, on that note, and get your reaction to what I think is the most apt phrase of the week, which is that the bond market is now in the driver's seat. You say not even so much the Fed. Now, maybe Powell's language here and there can give an opening to the market to test, and as it did today, continually kind of test how high yields need to go. But just explain what the dynamics are that you see here.
So let me just comment. I agree with what Steve said in his take on this. I think Jay Powell did the right thing in that he warned they may have to do more, but I also said they're going to move deliberately, which sets up if they decide to skip the November meeting, which I think they should. And so I think he's trying to position the Fed to do their job. The reason I say the bond market is responding to other factors, I think the bond market is responding, honestly, at this point, a little bit less to the Fed and more to the fact we're running very large deficits, very high deficit spending. The supply of Treasuries going forward is very significant. And it's not that the bond market, that we won't buy Treasuries, just you have to get paid more. And I also think the bond market is looking a couple of years over the horizon, maybe to a Fed funds rate that's closer to 3.25%, 3.5%. I don't know when that will be, but over a couple of years at 150 basis point term premium. And it's sort of starting to get positioned for that. So
let me ask you, why do you say that it might be, for instance, the deficit situation driving the long end higher, when people might say, well, but we've had stronger economic data and this is a good thing and that's why yields are rising? I mean, how do we know? So debt to GDP is now over 100%. Present value of unfunded entitlements is $75 trillion and growing. As was discussed in this interview, the Fed is no longer a buyer of Treasuries. It's, in fact, letting its balance sheet run off. The banks, we know, for obvious reasons, are no longer buying long-dated Treasury-related securities. And we've just come off a year that just ended where we ran close to a $2 trillion deficit. And people sort of yawn at that, but they need a reminder. Post-crisis, pre-recession, this is, as a percentage of GDP, a historically large deficit. Yes. And prospects are it's going to get higher. The other thing that's going to happen is the government bond market is going to reprice, and we're going to go from $620 billion of interest expense this year to higher next year and higher the year after as bonds reprice to these higher levels. Those are significant developments which will test the Treasury market. And viewers of the show have watched as we've gotten the Treasury auctions, especially in the past week, the 10-year, the 30-year. When they don't go well, we see yields spike and we see the market taking a leg lower on that. Steve, Powell was asked directly about fiscal policy and about the dynamics President Kaplan's describing, and he said, we don't focus on fiscal policy. We wouldn't change monetary policy because we think, for instance, the U.S. is on an unsustainable path. Everyone knows that. We're just going to focus on maximum employment and stable prices, which is their mandate. But there is a third part of that mandate in the Fed Act of 1977, and the third phrase is for them to focus on maximum employment, stable prices, and moderate long-term interest rates. And I wonder if this is the first time in a long time that third part hasn't come in conjunction with getting the first two right.
That's a really interesting point, Kelly. I will say rhetorically, Fed officials have eased up a little bit on their ban about talking about it. They have now started to reiterate this idea of the debt level being unsustainable. I will point out that when she was in the Federal Reserve, current Treasury Secretary Janet Yellen talked continuously about the unsustainability of the deficit. I'm not sure that has helped with the sustainability of the deficit now that she's in a position to matter in that regard. Right. I want to make one other point, and I'm interested if Robert Kaplan would comment on this, if you don't mind, Kelly. He twice talked about reaching this level of the sufficiently restrictive level. He said the first time in the speech, we're committed to achieving the sufficiently restrictive level. And then the second time around, he said, we're trying to achieve a sufficiently restrictive level. It tells you, Robert, you know better than all, as well as anybody, about choosing your words carefully. He is not ready to go and say the Fed is done. And I don't think it's crazy to think that if this economy does not slow, the Fed will do more. I agree with all that. And here's the unfortunate reason why they may need to do more. I don't think the organic or underlying economy is that much stronger than it was pre-COVID. I think the real Fed funds rate, honestly,
organically is still probably 0.5 to 0.75% real.